Well, good morning and good afternoon, wherever you're joining us. We are so glad that you're here with us today. You have joined Associate's webinar, and you can see the title here, HOA Insurance, Rate Increases and Other Expectations for 2024. I'm sure many of you are aware you are experiencing this issue in your community, but insurance premiums right now are really straining a lot of community associations. According to Community Associations Institute, community associations all over are staring at skyrocketing insurance premiums. Some are facing increases of as much as hundreds of thousands of dollars per year. Community finances are being strained, and in some cases, it's becoming impossible for new buyers to secure mortgage lending in these communities. My name is Greg Smith. I am the Director of Learning and Development here at Associate, and we are so glad you joined us today. I'll introduce our expert in just a minute, Jeremy Day, but some housekeeping for you. In your GoToWebinar panel somewhere, you should see a menu. It might be in a bar on the left side or on the bottom of your screen. You should see a Q&A or a chat function there. It should look like an icon that looks like a speech bubble. Feel free to put any questions or comments in there at any point, and we'll answer some of those questions throughout the webinar and after the webinar. You should see a place to download some of the handouts that we have available for you, which include the slides for today's webinar, an insurance coverage checklist, and an insurance claims process document that you can use for insurance in your community. We will be using some polls throughout this webinar to get your perspectives. We'll really find those valuable. And finally, we are recording this webinar, and we will share it after the webinar is over, so you can rewatch it or you can share it with somebody that wasn't able to attend. So again, my name is Greg Smith. I'm the Director of Learning and Development at Associa. And joining me today for this webinar is Jeremy Day. And Jeremy's a sales executive with Associations Insurance Agency Incorporated. Jeremy's been an insurance agent since 2016 after teaching in the public school system for 7 years. So kudos to you, Jeremy. Started in commercial transportation insurance and has been with AI for 7 years. And as a member of the AI team, Jeremy services, maintains, and develops commercial clients. He assists in new business development, and he manages an established book of business. So Jeremy, welcome. Thanks for joining us.
Thank you for having me.
Yeah, of course. A little bit about Associations Insurance Agency, Inc. It has been in business since 2003, so a little over 20 years. AI specializes in delivering exceptional and affordable insurance that is designed to fit the needs of community associations in particular across the United States. AI partners with the world's leading providers to insure thousands of community associations, and those include single-family home communities, high-rise communities, townhomes, as well as large condominium complexes. AI has decades of collective experience in the community management business, and the AI team understands the operational, financial, and legal challenges that face communities and shape the coverage that they need. So what we're going to do today is we're going to achieve these objectives. We're going to talk a little bit about the current market state. We'll give you some awareness about what's going on in the insurance market for community associations. We'll explain how and why that's impacting you and impacting community associations. Jeremy's going to provide you some really valuable cost-saving tips, and we'll give you some best practices for planning for 2024 and beyond with regard to insurance. Before we jump in, let's take a look. We'd love to get your perspective through our first poll, and you should see this poll pop up on the screen in a second. But before I launch it, here's the question: how significant are the premium increases for community right now? So I'll go ahead and launch that. And you should see that up now. So you can go ahead and vote there. How significant? None at all the way to severe, but maybe, I don't know, you're not sure, you're here just to learn. Jeremy will talk a little bit about sort of the global impact of insurance premium increases. So give you a few more seconds. What kinds of insurance premium increases is your community facing? Okay, we got some good response here. Thank you so much. Give it a couple more seconds. All right, let's go ahead and take a look at these, and I'll share these results. So a lot of you are facing, almost half of you are facing substantial insurance premium increases. split among the rest. The 2% of you that have none at all, that's fantastic. I hope that continues. I'm going to turn it over here to Jeremy. Jeremy, talk a little bit with us about what is happening in the insurance market for community associations.
So recently we've been seeing, and everybody who just answered that poll kind of, substantiated that we're seeing huge increases across many of the states, specifically in certain areas. I would say coastal areas or areas that have specific disasters that happen recently around them. So what we're really looking at, just our rates overall increasing because of a multitude of reasons, but some of the reasons that they've started were, look back, and I think it was in 2020 or just before, the Florida condo collapse that happened there, the freeze in 2021, the multiple hurricanes we've had, tornadoes across the country, civil unrest. This could be crime, increased crime in certain areas. This could be protest and vandalism. This could be just overall unhappiness with neighbors. And then even certain things like the Ukraine war have all really affected what we're seeing in this insurance market. And it's not affecting it in the way that you may think. You're saying, hey, the Ukraine war doesn't do anything for our insurance companies. Our insurance carriers that we use aren't insuring buildings over in Ukraine. Well, the reinsurance markets that back those insurance carriers are. And so they are the ones driving a lot of this increase across our country and trying to recoup a lot of what they've lost over the last, I would say, 4 years. Okay. When I first started in this industry, we saw minimal increases. It was even trying to fight people to go down. We would have carriers that were begging us, why are we not getting this, why are we not winning this property? Why are we not winning this insurance quote? And now we have carriers that are literally telling us they're making up reasons why they don't want to write insurance, okay, in certain areas because the risk is too high for their reinsurance markets, okay? How are they doing that? Well, the biggest thing that we've seen over the last couple of years has been a change in underwriting. So even in the last 5 years, the amount of questions that carriers have started to ask have become more substantial. Those questions could be year of construction, type of construction, age of roofs, location, number of units. Do you have life-saving equipment by a pool? Do you have a pool phone? Do you have, a lot of laws have come into place that these carriers are now asking, do these communities have these certain securities in place essentially for them to make sure that they're a low-risk community? And what we're seeing is they're finding small little things to not want to write these insurances, okay? We've started to see an increase in wildfire scores, okay? I live in Texas, I'm in Dallas, and I will tell you, we haven't had a wildfire here really around Dallas since I've lived here, and I've lived here since 1988, okay? And yet we have some communities on the outskirts of Dallas that are being denied coverage because of wildfire scores because the potential is there. Well, we don't have wildfires, but places like California, New Mexico, Colorado, Utah have all seen these increases in wildfires. And because these carriers are national, they are applying their rubrics, essentially, going back to my old teaching days, to all of these communities across the country. It's not just the ones that are in those specific areas, they're applying it globally, okay? And then the second thing was the reinsurance markets. Guys, these are the driving forces, okay? So whenever you have an agent that says, oh man, it's taking a long time to get approval from the underwriters and so on and so forth, a lot of times these underwriters are actually having to go get approval from the reinsurance markets to say, hey, we're allowed to quote this one, or we're not allowed to quote this one, or this is the rate in which we can quote this or not. And these reinsurance markets are essentially banks, okay? And for, layman's terms here, and what they're doing is they're really weighing out the risks more so than they ever have. And so because of that, we are seeing these increases because they're not willing to take these risks, and it's causing fewer and fewer markets to be available to some communities. And with less availability, demand goes up, and when demand goes up, prices go up, okay? So it's kind of a perfect storm we've seen over the last 4 years, but really that's kind of what's driving the market and the increases going up.
Yeah, Jeremy, you talked about wildfire scores. You're in Dallas, I'm in California. I see a bank of smoke on my horizon right now, right? So I understand wildfire risk here. Who is determining a wildfire risk score? Is that the underwriter? Is that the reinsurer?
No, so there are some certain programs, algorithms that these carriers use. Some are proprietary to each carrier, some are global that all these different carriers have gotten together to use to kind of determine these scores. So it's kind of one carrier may say you're in a high risk, the other one may say you're not. Okay, it's not just kind of a one-stop shop where we can talk about flood. Flood, we know if you're in a floodplain or you're not in a floodplain, it's done by FEMA. It's kind of a generalized sense. Hey, we know you're either going to get flooded or not. Wildfires, it's kind of hit or miss. What they're really looking at is, just the potential of wildfires. They're also looking at, and these are questions that we get a lot too, how far away are the fire departments? Are they in a city that has a fire department? That would be a determining factor. Do they have fire hydrants nearby? So they're also asking all of these questions. You may not hear or see or even be asked a lot of these questions. Your agents will determine a lot of these for you because we can look up a lot of this information. At least the good ones should be doing that for you. But that is something that, we're being asked as agents right now in this world.
Yeah, Jeremy, digging a little bit deeper, if you don't mind, about how some of these rates are being calculated for communities.
Yeah. So I want to first kind of talk about what we break up in our industry, what a condominium is versus what an HOA is, just because I'm going to kind of speak to both, and they have different risks right now. So a condominium to us could be a townhome, it could be even detached single family homes, but it's any community that we're insuring the residential buildings. Okay, this could be a business park, this could be a stacked on top condominium community, it could be a high rise, it could be a mid rise, it could be townhomes that look like row homes, it could be all sorts of different things. But for us, the determining factor is, are we insuring the residential buildings or not? Okay. For an HOA, or what we would call fee simple or single family homes, these are ones that all we're insuring is the common area and the common property. Okay. So you may have a clubhouse, you may have a huge amenity center, you may have a lot of property that you're insuring, and you may have millions of dollars to insure, but we're not insuring everybody's homes. Okay. So for us, that is an HOA. And then you can get even a little bit further and go into what we call an HOA master or a master HOA. The only difference between that and a single family is that it would have sub-associations. And each sub-association may have its own board of directors, it may have its own governing documents, etc. So when I talk about a condo, I just want you guys to understand I'm referring to places that we insure the residential buildings with. And when I talk about an HOA, I'm talking about single family communities that may just be doing the outdoor property, the general liability of the amenities that they have in that community. That being said, there's going to be some things that are going to affect condos more. HOAs are not as affected right now. They are seeing increases, and proportionally, they're seeing large increases, but for different reasons, okay? Mainly what we're seeing huge increases on are on the condominiums, the residential side of things. First thing is location, okay? Coastal regions are going to be your number one hardest to do for two reasons. One, you're going to get hit by hurricanes, flooding, wind, hail, all of that fun stuff, and this could be all over the country. But the other thing is coastal areas are also the places that a lot of people like to go vacation. And what are we seeing a lot there as well is short-term rentals. And that makes it a lot more difficult to insure in those areas as well. The next thing, this started because of the building collapse, was in Florida, was building age. What we are seeing a lot of carriers doing right now is they are no longer wanting to insure older units, older buildings, okay? The reason for it is the codes that were used to build those buildings back in the 70s, 60s, 80s, 90s, whatever, aren't the same as what we have for building standards today. The materials were different, the standards were different, everything was different. So when we had the big freeze in Texas, the places that were hit the hardest were the ones that had poor insulation or poor coverings around their pipes, whether it be around sprinklers or anything inside those condos. And those were all built in the 80s or the 70s or the 60s, okay? I'll give you a quick example. My in-laws' house, their outdoor or their water pipe ran through brick that was on an exterior wall. They had no insulation on it, and that's what popped when we had one in Texas here. So those building standards are not the same. So to cut back on risk, what these carriers are looking at is when was the units built, okay? Unless you have gutted and rebuilt the entirety of those units, they are going to consider those older units, okay?
Right.
Other factors too could be aluminum wiring, they could be stab locks or Federal Pacific panels. There are a lot more factors when you get into older buildings. So we've seen carriers, at first it started about 1985, then it went to 1990, then it went to 1995. We have a lot of carriers now that will not write pre-2001, okay? So because of that age, they are pushing a lot of these communities that have no losses, that look good, that are great, but they're pushing into our surplus carriers, and these surplus carriers have the higher premiums than what we would call admitted or quote unquote good carriers, if you want to go there, okay?
Yeah.
And then we get into valuation, and we're seeing this a lot when it comes to reconstruction. Think of the cost of plywood right now. Plywood is almost $50 a sheet back where it was during the pandemic, and the valuations on how much it would cost to rebuild a community have skyrocketed. When I first started 7 years ago, you could do a condo building walls out, meaning from the drywall outwards, for about $70 a square foot. Now it's $135 a square foot. So how does that affect you? Well, when the amount of coverage increases, guess what? The premium's going to increase. Okay. So what used to be insured for $1 million is now being insured for $3 million. Okay. And that difference in cost is going to be put back onto the homeowners at this time. And that's the part that we're seeing a lot of. And a focus on making sure that you have the right valuation. There are some carriers that you can still kind of walk in and say, hey, I want to insure it at the very, very low end. But most carriers now are doing their own valuations, and they are raising those prices because they are using their own algorithms, their own rating systems, valuation systems to make sure that they're not underinsuring a property. Because we've had in the past, a lot of times, you had a community that was way underinsured, they had a total loss, and now these people are suing these insurance carriers, etc. And so we are seeing these increases in valuation. This is also a big driving factor when it comes to deductibles. A lot of people nationwide are seeing wind and hail deductibles go up, but we have to have the correct valuation for those deductibles. And so the carriers are saying, we want to make sure those valuations are correct, so the deductible is applied correctly, and you are taking on the correct amount of risk as the homeowner.
Yeah, let's get some more audience perspective here. So our second poll that I want to put out here is this question here. How many quotes for insurance are you typically getting each year? Let's go ahead and launch that. Jeremy, what do you see on a more global level? What's a typical number of quotes that communities tend to get?
So everybody should be getting their renewal quote unless they are being non-renewed for some reason, and their agent should be getting them an alternative if they are. A good agent should be getting at least 2, hopefully 3, depending on the type of community. HOAs or single family communities are going to have more options. Condominiums are going to have fewer options. Okay. So in Texas, we may only have 1 or 2 options for you on the condo side because of the different limitations that we may have for underwriting. But for HOAs, we could get, I mean, I've seen as many as 4, 5, or 6 that we've had for different ones. And then you get into different stuff about deductibles. You could even play with the deductibles, and they could be different options for you as well, even with the same carrier. So there are conversations to be had with your agents when it comes to getting quotes.
Yeah, let's go ahead and take a look at this. And then we have an audience question I want you to speak to here. It's almost an even split between the top 3 options, 1, 2, or 3 quotes, and a few getting 4 or more. That seems pretty standard. Question, and I had a similar question about admitted carriers, but we can skip it. What is reinsurance? Can you talk about reinsurance really quick?
Yeah, on the base level, reinsurance are the people that essentially fund these insurance carriers. Okay, so I'm trying to think of the best way to put this. An insurance carrier may come into an area and they say, we have X number of dollars to write in a certain town. For example, we have a carrier, Honeycomb. They have a certain amount that they'll write in Dallas, Fort Worth. Okay. And so what that is being told is the reinsurance market is stating you have up to, let's say, $1 billion worth of total insurable value that you can apply to this singular area. Okay. Once you hit that, you cannot write anymore. And so these reinsurance markets are essentially setting the limits for the carriers on how much risk they can take on. Because a carrier could come in, I'll give you an example of one that went bankrupt recently that was based out of Florida, AmCap, American Capital. They came into a marketplace and they undercut everybody, okay? But they didn't really have a limit of how much they were writing. They were just kind of going after every community that they could get. The freeze happened in Texas. Even though they were based in Florida, they really hit Texas hard. And because they had taken on so much risk in Texas, that when that freeze hit, they had so many claims that they actually filed for bankruptcy.
Wow.
Okay. The reinsurance market helped pay for those claims that they could. The state came in and paid for the rest after they filed for bankruptcy, but it shut down that carrier completely. Okay. So what the reinsurance markets do is they look at it on a global scale and say, how much risk do we want to take on in these areas? Here is the limit in which you have. So think about a bank giving these carriers a loan essentially to insure.
I appreciate that. Thanks, Jeremy. Where are we generally seeing these increases? Can you talk about this chart, this map here?
Yeah, and I will say this, these are not in any particular order. Some are seen more in certain areas. For example, the Carolinas, you're seeing this more on the coastal area that you're seeing increases. Florida is its own animal. I will tell everybody this, that Florida, I don't write much in Florida anymore because the insurance carriers that are there are pretty local to just Florida. Louisiana is pretty similar. It's getting that way with Texas as well. Colorado is a high risk area for wind and hail and fire. New Mexico just got added to this list a little bit because of the wildfires. California, earthquake, wildfires. That has been a new thing. Tennessee and Indiana and a few others kind of in the Midwest are seeing some increases because of wind and hail. I see their deductibles changing. So you may not see as much rate increases in certain areas. Hawaii after the wildfire there, of course, and then, you know, the risk with all the weather that comes with Hawaii. But with like the Midwest, you may not see a ton of premium increases. What you're starting to see is what some of other states have seen already in the change in deductibles. So you go from a flat wind and hail deductible of $10,000, and now you're paying 3 to 5%, excuse me, which could be $250,000 wind and hail deductible now. Okay, so that's where we're starting to see those creep in those areas. Minnesota is also one that was hit hard about 6 years ago with hail. Their market has kind of rebounded a little bit. And we always talk that insurance is kind of cyclical and that it will go into high points and low points. And we call this a hard market right now. There are projections that in maybe 26 or 27 that will start to soften. In 25, it's probably going to level out in a lot of these areas. But that's really just kind of a determination of what carriers are in the areas, who is coming back into the market, what new carriers are on the market, kind of the competition, the supply and demand aspect of it. Right. One driving factor for Texas is Lloyd's of London came back into Texas just recently to write some of the higher risk communities, and they had left for about 2 years. And now Lloyd's of London, their policies, you know, are very expensive, but at least some of these communities that weren't able to get policies are starting to get policies again.
Okay. You mentioned when you were talking about risks earlier, Jeremy, you were talking about tornadoes, and I would expect to see then more rate increases in the plains areas. But are you saying instead of premium increases, they're seeing more deductible pressure?
Yes, and also I would say for HOAs, condominium, stuff like that, you don't have as high of a density in those areas.
Okay.
So for example, like Kansas, Oklahoma, Nebraska, you of HOAs, you don't have a ton of condominium communities. You do in metropolitan areas, but from the most part of the state, the risk is still low. Okay. So, for example, Colorado, you have Denver, Colorado Springs. In Texas, you have kind of the triangle that you have there with San Antonio or Houston, Austin, and Dallas. You can throw San Antonio in there. But outside of there, you still have HOAs in those areas, outside of those major metropolitan areas. Whereas in the Midwest, you really don't. I mean, they're lower density, places. So rate increases aren't going as high because they're viewed as not as high of a risk for those insurance carriers.
Understandable. The risk is there, but the potential impact of those risks is not as high because of density. That makes sense. All right, so let's get personal, right? How is this affecting communities that might be on this call? How's this affecting board members that might be on this call? And what can they do about it?
Yeah. So number one, I kind of alluded to earlier, this is really speaking more towards condominiums than it is towards single family homes, but it does apply a little bit to if you have clubhouses, things of that nature. And really, when you're talking about outdoor property, something else that you need to make sure you consider, that's kind of number three I'll get to. But for the most part, you need to know how much your insurance is covering, okay? So if you're looking at your building, if you're at $100 or less as per square foot by your commercial policy, the one through the association, then you're probably underinsured, okay? And this is around the country, okay? This is not just in those areas that I said were highly affected. If you're over $200 a square foot, depending on where you are, again, like if you're in California, you may be a little bit higher, okay? Then you may be a little bit overinsured. So what we tend to look at is a walls out policy, or what we call bare walls, would be $135 a square foot on average. And for a walls in coverage, you're looking at about $175 per square foot on average. Now, there is a third policy called an all-in policy. We see these a lot in retirement areas. That would cover the betterments and improvements. Those would be over $200. Okay. The reason we kind of use that price per square foot aspect is that your policies nowhere in there will say the words walls in or walls out. Okay. Right. Your governing documents will, and the declarations and the insurance portion, not the maintenance portion, the insurance portion. But the policies will not say those words. Your certificate of insurance may say it, but the policies will not. How they determine how they're covering the association is, one, they use the declarations as their guideline, as the carriers do, carriers and agents, and they look at the price per square foot. So like I said before, some carriers will let you go on the low end. I've had a carrier tell me recently that for a walls in policy, they can get as low as $125 a square foot. Okay. Now that's a high risk for some communities because they should really be about $175 or $185 a square foot. So you're going in at $60 a square foot less than what you should be. There are other communities that are, overinsured. They're at $150 and should be closer to $135. So knowing what your cost is, and the way to figure that is you take your building value, what you have insured for, take out the outdoor property, and then divide it by your total square footage of your community. And that will give you a general sense of where you are. Some people are still stuck at the $70, $80, $90 a square foot, and they're seeing these huge jumps in premium because they've never reevaluated how much they have. Now, there are some ways around it. We'll talk about them later, but I'll just reference them. A reserve study, an insurance appraisal, or just kind of knowing your policy is all going to help you in trying to figure these things out. For HOAs, the two biggest things that we're seeing right now is general liabilities are going up. So even about 2 years ago, you could get a general liability policy most across the country at about $3 a unit, maybe $5 a unit, something like that, maybe even less, maybe a little bit more. We're seeing those jump to like $10 to $13 a unit, okay, for single family communities. So, and they've jumped gradually. So some of them went to like $7 or $8, and it doesn't seem like that much when you start talking about communities that are only 25 units or 50 units or something. But when you start to get to the 400, 500 unit communities, that is starting to be a huge impact. Also, when you're a smaller community, you don't have a ton of assessments coming in to fund your community. And so adding another $1,000 or $1,200 a year for insurance is a huge increase. Okay.
Right.
The problem is those general liabilities, there's nothing for us really to do about it because it's based on the number of units you have. So the carriers are only rating, they're not rating, I mean, they may add surcharges for a pool, a pond, a playground, a dog park, something of that nature. Or if you're on like a marina or a lake, they may add some surcharges there, or coastal. But what they're not doing is they're not taking anything else into account other than the unit size, the unit count. So if you have 500 units, that's what they're basing it off of.
Right.
Directors and officers the same way, but that's stayed pretty level at this point. And then the last thing you need to do is just kind of consider your common property coverage needs. Okay. I've seen a lot of people who want to overinsure their property and some people who want to underinsure their property. You've got to find the happy medium. So you have to know what you should insure. If you have 2 light poles in your entire community, do you need to insure them if you have $1,000 deductible? Probably not, because one of them being hit may only cost you $1,000 to replace. You would never hit the deductible. You may not have both fall down at the same time. It may not be worth it. Or conversely, you have a brick wall that surrounds your entire community and you're insuring it for $50,000. Well, if you have a major section blow over, you may be completely underinsured in that situation. There are also some things that you may need to consider as well, like landscaping is really hard to insure now because wind and hail and freezing all across the country with every carrier is excluded. Well, what else is really going to hurt it? Wildfires may be excluded in the hot spots there, and the other things that are going to happen to it are maybe somebody drives over your front entry monument and your beautiful flower arrangement there. They might hit a tree that will help with the debris removal. Lightning may strike a tree, may help with the debris removal, but it's not going to replace a 100-year-old oak that they have there. They're going to put a sapling in with a limitation of about $2,500. So carrying $800,000 in landscaping may not be beneficial to your community. That is an area where you can reevaluate. I'm not saying to cut it all completely. I'm just saying reevaluate what you're insuring and have your agent do what they call a statement of values, and they should break it out by category. Now, in my case, all of our fencing is going to be grouped into one. So your perimeter wall and your fencing around your pool is going to be included all in one value. Okay. So that has to be taken into consideration. Don't be like, hey, we have this wall, we have that wall, we have this fence, we have that fence. Most of the time, you're going to see it as one single entity. So take into consideration those items. We have examples that we can always give out of what a statement of value is, what we use, and what most carriers are looking for. But you can get very specific: security cameras, guard houses, the stuff inside of them. A lot of people forget about the contents of a clubhouse. Think about the furniture, any electronics, artwork, appliances that they may have in those things. That thing burns down, what's paying for it? Because you don't have a resident living there who has an HO6 policy or an HO3 policy that's going to refurbish it. That's on the association. So those are the things to consider when you're doing that.
Can you bring a little bit of clarity? Because some folks are asking, we just want to make sure we're on the same page. Walls in versus walls out in terms of property coverage. And we're talking about condominiums here, right?
Correct. So the best example I can give you is walls in, which is the most standard. And if you have condos that are stacked on top, that have horizontal boundaries, you're going to have a walls in policy. Okay, regardless, I can almost guarantee it. And the reason for that is you don't have defined enough spaces who's taking care of the roof above those houses. Okay, so it's going to almost always be a walls in policy. Walls in, take your unit, dump it upside down, and whatever stays in there is the association's responsibility. Whatever falls out is the homeowner. That's the most basic of things that I can, basic ways of talking to it. Really, it is how you first bought the unit. Okay. If you put any betterments or improvements, this could be a new type of tiling, countertops, etc. Those will be on your own dime when it comes to insurance. Or if you change the square footage. We've had some people who've roofed in atriums and made the atrium part of the interior now. Those would all be something that would be on your own dime, okay, or your own personal insurance. But when you're talking about walls in, it's pretty much what's all standard: cabinetry, toilets, light fixtures, floor coverings, but not things like blinds or curtains or any decor. That's going to be on the homeowner. Walls out policies are from the drywall out. Okay, so if you imagine this, walking into a space that is drywall on the wall, concrete or plywood floors, no light fixtures, no cabinetry, no floor coverings, no toilets, no sinks, nothing, zero. It is just a shell. That is what a walls out policy is. Now, where you get into a kind of a debate on, and this is where insurance carriers fight back and forth between personal lines and commercial, is who's responsible for certain plumbing and electrical. Okay. The best rule of thumb to use, and this is not everywhere, and this is not everybody, it would be based on your governing documents, but the best rule of thumb is if it services only your unit, it's your responsibility on a walls out policy. If it services multiple units, it's the association's responsibility. Okay, that's the best rule of thumb. Not a guaranteed, not a hard and fast rule, but that's kind of where we start. All right. For a walls in policy, it doesn't matter. The electrical, the plumbing, that would all be a part of the associations because that's permanently fixed in there. Now, underground pipes, again, aren't going to be covered by most policies because there's not many things that can happen to them that are an insurable act.
Right. So generally speaking, a walls in property insurance policy is going to put more of a burden on the association in terms of a loss. Walls out would be more of a burden on the homeowners, the unit owners.
Depends on the loss. So okay. Wind and hail is going to be a burden on the association for both of those type of communities.
Got it.
For example, if you have a hail claim and you have to replace all of the roofs of 30 buildings in your community, it's going to be a burden on everybody.
Right.
But if you have a pipe burst in one single unit, it may be more burdensome for the homeowner if it's a walls out versus a walls in policy. So it really just kind of depends on the type of issue. But yes,
Understood.
I mean, because you're covering more, you're going to have more claims. So I would also talk about, and this is maybe something in the cost savings, looking at your deductible per what you have for your type of coverage. A walls in policy, you may want to carry higher water deductibles, higher what we call an AOP deductible, because it may stave off some of these smaller claims that these people try to file that would then be filed on their homeowner's policy up until that point, because they may be responsible for the deductibles. And because of that, you will have a cleaner loss history for the association, which will keep premiums down.
Got it. Yeah, let's come back to that in a minute. Some cost saving measures. Let's do another poll here. So in terms of if an insurer declines to offer your association a policy, we're curious, what are the reasons they're giving? Is that what this question? This isn't about claims denials. This is about coverage denials, right?
No, this is about coverage. So why are they saying they won't write you in your area?
Yeah, if you've been told, poll should be up. If you've been told that an insurer will not offer you a policy, why are they telling you? Is it wildfire? Is it wind and hail? Is it building age, like Jeremy talked about? Or can you even know? Will they even tell you? Are we seeing a lot of that? We're just being declined, Jeremy, and nobody will tell us why? Are you seeing a lot of that?
We can get a response from the carriers on why for the most part. And we have to do what we call a due diligence when we submit to certain carriers. So we'll have to explain why they were denied at certain areas. We're seeing this a lot on renewals of people that had coverage through a carrier, and then they will be non-renewed because something has changed.
Right.
So we'll see a lot of that. And if we do, we'll tell our clients, hey, Philadelphia will no longer write you because you're in a wildfire zone and they don't want to take on that risk anymore. That's a new change. Another reason we've seen recently was the amount of losses that you had. They have a claims percentage, and we had a community that had a loss 4 years ago. They've had the same carrier for 4 years, and because of that loss happened that was 4 years would be coming off next year, it no longer hits their claims ratio. They non-renewed them and moved them off. So there's a lot of factors, but these are the big ones that we're seeing.
Yeah, unfortunately, it looks like a lot of our attendees today, they just don't know. They're not getting that information as to why they're not being offered insurance.
And that's questions you need to be asking your agent. Why are we not getting quotes? Where are you going? Who are you going to? What is the reason? Because if you're getting the same reasons from multiple agents, you're going to be able to kind of understand and explain to your homeowners, hey, we went here, here, and here, and they all denied us because of our age, or they all denied us because of this or that. And so you will have more ammunition when you get into those meetings, those general meetings.
Yeah. Jeremy, you've talked on some of these already, but talk a little bit more. What can boards do? What communities do to sort of maximize their coverage and minimize their increases at this point?
Yeah, so first thing is you have to understand your coverage. And what I mean by that, going with condos specifically more than anything else, knowing your rate. And this is for the property. And I will talk, most of you are seeing increases on property insurance. You're not seeing as much on directors and officers, crime fidelity. You may see some on general liability, and you may see some on umbrella. But most of the increases we're seeing is on the property side. So knowing your rate. And there's an easy way to figure this out. It's taking your property premium, okay, and then dividing that by how much you're insuring. So for example, if my premium is $4,000 for property and I have $1 million in coverage and I divide those out, I get 0.04 or 0.004. Then I would multiply that by 100 and I would see that I have a 40-cent rate, okay? So that's kind of your generic way of doing it. If you want to talk to your agents about what kind of rate am I getting, that is something to talk about. For example, knowing that information, then we'll know, hey, is this person competitive or are they not competitive in this area? So knowing what everybody else around you is getting. In Georgia, 12 cents is a really good rate. 14 cents, maybe even up to 18 cents, but sub 20 cents is really good. In Texas, if you get below 50 cents or at 50 cents, you have a really good rate. Now, we've seen them, and this is not everybody, but we've seen some Texas rates that have gotten down to 25 cents. I've seen some Georgia rates that have gotten down to like 8 cents, okay? But I've seen some Georgia rates that have been as high as 35, 40 cents, and I've seen Texas rates over $1 per 100. So you just got to know what your rates are, and you got to know what those factors are for your rates. If you have aluminum wiring, if you're in a bad area, if you're in high risk, if you have an older building, you may have higher rates. So what is a good rate for your building? Okay. Understanding your coverages and deductibles. All right. So first off, there are 5 main policies that you need to have, or you should be considering. The first is property. The second is general liability. The third is directors and officers. The fourth is crime fidelity. And the fifth is umbrella. Okay. Now, do you need all of those to run your community? No. The 3 main ones that you probably will always carry is property, general liability, and directors and officers. And per everybody's management contracts, this is all management companies, you should at least maintain general liability and directors and officers, okay? Now, knowing what coverages you have and then what your deductibles are. You could have a deductible that is not laid out for you in your proposal, that is $25,000 per unit for a water loss. Well, why do you have that there? Well, we've had multiple water losses, and this was a way to keep the premium down, is to do it per unit water loss deductible, okay? Or you could have a higher wind and hail deductible. In Colorado, I've seen it get up to as high as 10% of the building value is a wind and hail deductible. A good one would be 3%. Okay, so, and then there's certain areas in Colorado, they won't even write wind.
I remember when 2% was excessive.
Yeah, so when I first started this, most people, especially HOAs, were at $1,000. Condos were at $2,500 for all deductibles.
Wow.
But think about having a roof claim. If you have $1 million roof claim and you have a $2,500 deductible, these insurance carriers were losing their tail. And
Right.
with all of these hailstorms and tornadoes and windstorms and everything that's happened in this country, they've had to replace more roofs than they want to consider. And so they're raising these deductibles. They're putting more onus on the homeowners. Otherwise, your premiums would be through the roof. If you can always buy down a deductible, you can always ask for higher deductibles. Okay. Now, are all agents going to give you higher deductibles? Are all carriers going to agree to it? Maybe, maybe not. But this is knowing your coverages and asking for those things to see what those rates may come in at. Okay. Also, when it comes to deductible, there is especially wind and hail, you could do a wind and hail buy down policy, which essentially takes a percentage deductible and it buys it down to a lower percentage or to a flat deductible for wind and hail. Those are very expensive policies. They're through Lloyd's of London. So how can you get around that? And here's the kind of solution a lot of communities are doing right now. Instead of paying for a policy to pay for a deductible that you may or may not use in a year, they are now putting the onus back on the homeowners through what we call loss assessment coverage. Loss assessment coverage is the new hot topic in the insurance world because what it is essentially you can special assess as an association for an insurance related act. And when you special assess, those homeowners can take that special assessment and file it on their homeowner's policy, and it will pay for that special assessment. Now, the special assessment has to be for an insurance-related act. It cannot be for, hey guys, we're going to redo the pool. Let's get let's do a special assessment. It has to be for an insurance-related act. So you have a big deductible you have to pay. Instead of buying down the deductible, you tell your homeowners, hey, make sure you carry $10,000 in loss assessment coverage, and you will file it when we have to, because it's not a matter of if, it's a matter of when we have to file this claim. Now, how much are those policies? Well, most people already have them on their HO6 or HO3 policies, mostly HO6s. And for the last I looked, for $10,000 through State Farm or Farmers was $20 a year.
Wow.
Or less.
Wow.
So you're putting something, instead of paying $70,000 and charging way more on assessments on a monthly basis, you're putting more ownership back on the homeowners. And if they don't want to do it, or they have the funds that they just pay for those special assessments, fine. But a lot of people are taking, hey, I want more in my bank account monthly, and we'll take that hit when that special assessment comes versus pay for all those lower deductibles now. Make sure you check your governing documents to make sure you don't have a specific deductible you have to hit,
right?
Because there are some in there that were written in like the 90s that nobody foresaw that the deductibles got this high. Okay.
Yeah.
The next thing would be to verify all of your information. Even if you have the same agent for the last 10 years, make sure you have everything. You may have added a playground and they didn't even know it because they just kind of auto renew. Like, hey, they don't ask you. Every year we send out an info verification form about 120 days out, about 120 days out to our communities to verify the information we have on file is correct. And this helps with the renewal process for us because in a lot of cases, these carriers are auto renewing single family communities. And so if we don't tell them there's any changes, they're not going to make any changes. They're just going to auto renew it at the new rates, and they're going to send us the renewal. Okay. So confirm those situations. Make sure and reevaluate your property that you're doing. This is where I was talking about earlier on how much are you insuring for landscaping? Are you insuring paved surfaces? Do you really need to insure paved surfaces? How much are you doing for fencing, for your pool? I mean, I see a lot of people who want to put $250,000 on a pool, but when you think about it, what's really going to damage a pool? It's concrete and water for the most part. Cracking isn't going to be covered because that's changed over time.
Right.
You know, the worst thing is going to happen is to the equipment, not to the actual pool itself. And the equipment is not going to be $250,000. Now, am I saying drop your insurance drastically? No, I'm just saying reevaluate how much that you have in place to make sure that you're insured correctly. And on the flip side, if you may be underinsured, you may want to do that because there are things coming on the market like co-insurance that you could pay a penalty that because you're so underinsured. So you want to be having these conversations with them, with your agents, to make sure you're insured to value. The next thing would be to bid out every year. Unlike your credit score, it does not hurt you to bid out every single year. It benefits you. There is one caveat to that. If you go to too many agents, they will start blocking each other. Most insurance providers in the commercial industry will only release one quote. There are a few that will release multiples, but for the most part, most will release only one quote. So if I go to one agent and then that same agent tries to access that same carrier, he's going to be blocked. Well, that may be their only option. The issue is that other agent may not even show you that they got a quote from that community, that carrier. So you want to make sure you're trying to talk to a couple agents at a time if possible, or talk to an agent who's a broker who can go to multiple agencies or multiple carriers. Like ourselves, we go to multiple carriers. We have, like in the state of Texas, we have 95% of the market that's available to Texas. Okay. There's a few carriers that we don't have. Nationwide, we may not have, certain carriers we don't have is like auto owners, State Farm, a few of like those that are more on the personal lines, but do dabble in the commercial industry. But we do have some of the big players: Philadelphia Community Association Underwriters, Travelers, Lloyd's of London. We have all of those as well. So we can go to all of those each year to try to provide you multiple bids. So give your current agent the first opportunity and then take him out to see if there's something else that somebody didn't have. Because, for example, we have exclusive relationships with certain carriers that your current agent may not have. And so I'm able to provide you a quote from that carrier, and the other agent couldn't even access them. Okay. So there's always ways to look around. Two things to be careful of, though, is don't go to like a State Farm or Farmers agent that is your best friend unless they do the commercial industry, because they could write the wrong type of policy from those carriers. There are different things. There's what we call a BOP, which is a business owner's policy. That is not the correct type of policy for an association. It is a true commercial policy that you need. A BOP is for like a restaurant or a motel or something of that nature, or a family-owned business. It is not for an association. Are they close in coverage, and are there going to be agents that are going to tell you it's the same thing? Yes, but they're not. And so you just have to be careful, because you can run into lawsuit issues when it comes to filing on a directors and officers or something of that nature. State Farm also has an issue with a certain type of D&O policy that they call an endorsement policy. It's really cheap and it looks nice, but it's not very good coverage. So just be aware of who you're going to when you're talking to it. Really try to find people that are players in the commercial industry.
So Jeremy, just in the interest of time, let's jump ahead and just ask, is there some hope? Is there some hope here? Is there a light at the end of the tunnel?
Yes and no. Okay. Depending on your area, we've seen it slow in some areas. We've seen it kind of level out in others. And then there's some areas that are just keep getting hit. For example, Texas just keeps getting hit. New Mexico, they're going to start, probably seeing some increases because things that have just happened. So it's really kind of knowing what's going on in your area. I will say overall, unless we stop having major natural disasters, it's not going to slow or soften like it was 5 years ago. Now, it may soften a little bit, but it's not going to get down to where we had seen it before.
Okay. And you mentioned this earlier, having a reserve study, maybe getting an appraisal done can be really helpful in figuring this out. Okay. All right, final poll. We'd love to ask you all out there, just when thinking of insurance, what are your pain points right now? Let's just put this up here. How is your relationship with your agent or your broker? Are you seeing, I think a lot of us are seeing premium increases. Are you having fewer options? Just generally, when you think about insurance, what are you experiencing? And I'm sure, Jeremy, a lot of people are going to answer yes, premium increases, that's why they're here. But
yeah,
anything else you're generally seeing on this question, Jeremy?
Communication with agent and brokers, making sure that they're presenting all options available to them and to you at that time. Being, forthright. Like sometimes we'll have carriers that will hold on to the quotes until the last minute, and it's our job to communicate to you that we're still waiting, that they're going to quote, and we're just waiting on the final numbers. But you're going to have something, or hey, we haven't been able to find something, and give you time to go look for other quotes. You know, I will say interest rates are going up, but it doesn't seem to be a huge pain point because it's everybody's seeing those increases across the board. But yeah, and lack of options. I mean, that just kind of depends on your area and who you're working with and broker. I mean, when we put that question up earlier, how many proposals or options are you seeing? If you're a condo and you only have one option, well, did they only go to one carrier or did they go to multiple carriers and they pick the option that's best for you, or best for them even? Because I will tell you, as an agent, we have relationships with carriers that we want to write more with and than others. And so even though we may have gotten a quote, it may be more beneficial for us to write with a certain carrier. So they may harp on that one a little bit more or present only that option. So just being transparent is what you want to look for in an agent when you're doing this, and having that good communication.
Jeremy, what would you say are the number one, number two key takeaways from today you'd recommend these board members keep in mind?
Be involved. The number one thing I would say is be involved in your quoting. Okay. Just letting your agent do it is going to put you in a world of hurt, because you may get behind the 8 ball. You may run out of time. You may not know why things are going up. You may not see the changes in deductibles. So just being informed, being a part of the process with your property manager at that time is something that I would say is a huge takeaway in this. And also, don't always pick the cheaper option. Make sure you look at the coverage, because the other thing you can see is if you don't have the right option, if you're just going based on money alone, I know it hurts right now, but if you had a certain loss and you had a poor coverage, you may be paying for way more out of pocket in the end than it is just because of it's cheaper right now. Okay.
Yeah, the final question we had is related to that. It's about that loss assessment coverage, Jeremy. So can you just clarify, loss assessment coverage applies when there is a covered cause of loss? Loss assessment coverage for a condominium or a homeowner.
Yeah, it's going to apply
does
more.
not come into play when there's an insurance premium increase.
No. So you have to have a loss. So where we see this the most is with wind and hail, and they have to replace the roofs, and you have a $500,000 deductible for an association, and you break that and you special assess everybody that you have to pay for that $500,000 deductible. Then you can take that on your loss assessment coverage on your HO6 policy, your condo policy, personal lines, and apply it there. You may have to pay a $500 deductible, but I would rather pay $500 than $10,000 to a special assessment, personally.
Right. Well, Jeremy, thank you so much. This was a ton of information. I know we have a lot of questions, and I'm sure we could stay here for another hour just asking and answering particular questions. But thank you so much, Jeremy, for walking us through this today.
Yep.
Yeah,
Anytime.
thank you all out there for being here, for participating in those polls. If you haven't seen it, we are having another webinar on August 14th about the Corporate Transparency Act and what that means for community associations. Remember, this is being recorded. We will share that. There are some handouts here. If you have any questions, please reach out to us. We'd love to help you, and we'll see you on an upcoming webinar. Take care. Thanks, Jeremy.
Thanks, guys.